Adam Reisler, partner at the StepStone Group. Adam, first of all, thank you very much for participating in the Inside Network's Alternative Symposium.
No, thanks for having us. Glad to be here.
Yeah, great pleasure. Adam, for advisors that are new to private infrastructure, and I would imagine that's the majority of advisors, what sort of benefits do you look at, and what are the diversification benefits of the investments you make?
Well, it's interesting because it might be new to a lot of the advisors, but it's actually a topic that's coming up more and more. So I think we're seeing the interest level, and whilst it's always, has predominantly been an institutional asset class really up until the last couple of years, given the difficulty to access most of the available sort of infrastructure products in market. The actual benefits for portfolios are not that dissimilar to what institutionals will look for. So the benefits to a portfolio can be low correlation to other parts of the portfolio, particularly public equities and debt. It can be lower volatility. So we're seeing over the last 20 years sort of comparable returns to a lot of other asset classes, but with less than half of the volatility. So lower volatility, lower correlation, being able to lean into a lot of thematics. So I think everyone's reading in the newspaper every day around energy transition and the need for digitalization and increased spend on data centers and AI, compute, and all that factors into the growing asset class and infrastructure, and investors really want to get access to that.
You target mid-market infrastructure investments at StepStone. What are the unique challenges and advantages of that compared to large-scale, large-cap projects? And extending that, how should investors think about balancing exposure between these segments?
Yeah, well, actually, we cover the entire market, but I think interestingly enough, it's a very, very broad market. And so covering mid-market is very difficult because there's a lot of names out there. I think roughly 80% of the actual funds in market are mid-market. Representing about maybe 40% of the capital, but it's a very, very broad market, and we see a lot of interesting opportunities in that space. But what we find is the actual, we've done a lot of analysis around actual returns in these strategies versus the mega caps, and we're seeing a much bigger dispersion of returns. And so what that tells us is selectivity matters even more in this space than it does for the large cap managers. Obviously, being selective is important everywhere, but it means that if you choose well in the mid-market space, you have an opportunity to produce outsized returns. And so we think bringing a lot of discipline to and broad coverage of that space can deliver some really attractive returns for investors in what is otherwise a pretty crowded market.
Given the broad range of subsectors within infrastructure, some of the ones you've mentioned, clean energy, telecommunications and transportation are others, how should investors determine the really optimal risk allocation across these areas if they're looking to balance risk and return?
Look, I think the way historically infrastructure investment has occurred is it's been a relatively diversified way already. A lot of generalist strategies are covering the key thematics. And so most products in market are generally going to give you access to energy. They're going to give you access to transportation and digital assets at the moment. It's by far the largest sort of deal flow that we're seeing in the space, and it's really where the thematics of sponsors are focused. So I think if you don't have a very, very large portfolio in infrastructure, if you can't cover a lot of sponsors in market, I think accessing investors and sponsors and products that can give you access to all of these thematics, either through one or two different access points, I think is probably critical, rather than trying to be very selective when you're not able to sort of coverage and have the discipline and sophistication around the broader infrastructure landscape. So I would urge investors not to try to be overly concentrated or to pick a winner. I think if you pick high quality products and sponsors, typically you'll get access to a lot of those thematics already.
AI is obviously an exciting theme, and many advised clients are trying to get access to it, asking their advisors about it. To what extent would you say modern infrastructure assets are incorporating AI digital connectivity?
Look, I think a lot of asset owners are trying to find ways to get an advantage, and they're trying to not just get an advantage, but keep up with what is really a disruptive technology. And so we're seeing AI implemented in utilities, we're seeing it implemented at ports, and we're seeing a lot of efficiency being created in that space. But the real story, I think, in AI and infrastructure is what AI is going to require from an infrastructure investment standpoint. And we're seeing obviously a huge proliferation of the need for data centers and data storage and compute power, which really is at the heart of what the next sort of evolution of infrastructure asset class is going to look like. And so being able to play that space well, to pick the right sponsors, to know what the future data center should look like, I think those skill sets as an investment manager and being able to select well in that space, I think is really going to be critical for managing the disruption of AI and frankly, the opportunity of AI going forward.
The Alternatives Symposium closes with a workshop that explores the institutional approach to alternatives. What guidance would you have for advisors who've looked at that institutional approach, looked at the success institutions have had with alternatives, and the private wealth advisors? What would you say to them how you could replicate what we see in really large institutional investors like, say, a superannuation fund?
Yeah. Well, what's interesting is, even though some of the very large institutional investors have a lot of capital to deploy, they don't often have very big teams. They're not always geographically dispersed. And so even for them to cover the market is very difficult. So we often see a lot of the large institutional investors partner with managers who can help them navigate the landscape. And frankly, it's very difficult to build a very diverse and broad investment approach to infrastructure just through investing in funds. And so we're seeing a lot of investors lean into what we call co-investments and secondaries, which is an ability to get sort of diverse exposure across different sponsors and different strategies and sectors, as opposed to having to pick one or two funds where you get sort of singular sponsor exposure. So I think the institutional approach is, how do I get the most efficient, diversified exposure to the landscape? And often that does require a mix of strategies, which often include secondaries and co-investments, in addition to your traditional fund investment.
Adam Reisler, StepStone Group, thank you very much for your time today.
Great, thanks for being here. Cheers.
Pleasure to have you.